How can advisors harness duration when equity markets turn turbulent and interest rates are shifting? Hi, I'm Samuel Martinez. In this video, I'll talk about how you can use duration to steady equity exposure, explore alternative bond sectors as diversifiers, highlighting key trade-offs, and point to where bond opportunities may be emerging right now. Usually investors think about allocating away from equities to fixed income as a cost. It certainly dampens vol, but it also has some other benefits. The equation around fixed income has changed meaningfully in recent years. From 2010 to just before COVID, the average yield on the 10-year Treasury was about 2.4%. Since 2023, the average yield on the 10-year has been about 4.5%. That's a big difference, and that does a lot to reduce the opportunity cost of adding fixed income to your portfolio. Because fixed income delivers a consistent return, that return acts as a cushion that helps balance out periods when prices move lower. Right now, that tends to be larger in the front end and a little bit smaller on the long end of the curve. That's one of the things that makes the front end of the curve a potentially attractive alternative for investors who aren't ready to take all of that duration risk. Now, it doesn't mean that duration risk is bad. Extending out the curve has a lot of benefits like diversification, but it just means you need to be thoughtful about the time horizon and, of course, have portfolio construction top of mind. Credit can be a great sweetener that provides incremental returns and can also offset some of those opportunity costs that come with a marginal allocation away from equities. Credit in the front end shares some of the attractive characteristics of treasuries. That is, really attractive break-evens, that cushion in returns that you get in the front end. The key with credit is that you need to have prudent spread exposure. Valuations are tight. It's important that you have a keen focus on credit selection, picking the right names, and in this environment, probably having an up in quality orientation for your credit exposure. There is a middle ground. You don't have to extend to a full duration core product. For example, in today's market, extending from short-dated treasury bills to a credit-oriented short-dated bond fund can provide attractive incremental yield without the duration risk of longer-dated bonds. What's more, if you can identify a highly skilled active manager in this space, they can be working on your behalf to monitor the portfolio and position it to achieve even more incremental return. A good example like this in our product line is the Vanguard Short Duration Bond ETF, ticker VSDB. There's been substantial focus on private credit. The growth has been enormous. And of course, we've seen a few hiccups along with that growth. That doesn't mean that private credit can't be a good diversifier to a portfolio or even a really critical part of it. But there's a few key things that you have to have in mind when you're thinking about exposure to this asset class. You need to have a great manager, you need to have great due diligence, and you have to pay really close attention to your time horizon, as well as your tolerance for a lack of liquidity. Private credit is going to be much more complicated to buy and sell. It's hard to overemphasize that fact. And with private credit, you typically need to hold to maturity. There are other ways you can get liquid assets that will add incremental yield without some of the downsides of private credit. For example, if your clients are willing to commit capital for a longer period of time, there are compelling opportunities in the municipal bond market. The curve is very steep right now, and that means bonds out the curve have particularly compelling returns. The Vanguard Core Tax-Exempt Bond ETF, ticker VCRM, is a thoughtfully built product that gives your clients exposure to this opportunity managed by a world-class active municipal team. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.